Understanding bonds and their risks. A bond is an IOU for cash lent by an investor to the bond's guarantor. As a trade-off for the utilization of that cash, the guarantor consents to pay interest to the investor at a stated rate known as the coupon rate. Toward the finish of a settled upon time span when the bond matures, the guarantor reimburses the investor's principal. Benefits and risks of bonds. Because bonds tend not to move in tandem with stock investments, they assist with giving expansion in an investor's portfolio. They also provide investors with a steady income stream, usually at a higher rate than money market investments. Footnote 1. Zero coupon bonds and depository bills are exemptions. The premium pay is deducted from their price tag and the investor then, at that point, gets the full assumed worth of the bond at development. All bonds carry some degree of credit risk or the gamble that the bond issuer may default on at least one installments before the bond arrives at development. In case of a default, you might lose some or the pay you were all qualified for, and, surprisingly, some or all of chief sum contributed. To assist with estimating credit risk, many securities are evaluated by free substances like Moody's and Standard & Poor's SP. Ratings run from AAA, Moody's or AAA, SP, through D, for default, based on the rater's appraisal of the issuer's creditworthiness. AAA, Moody's and AAA, SP are the highest credit ratings. Ratings better than BBB, SP, and BAA, Moody's are considered to be investment grade. Bonds that are rated below investment grade are at times called garbage bonds. Footnote 2. They may be appropriate for investors who can endure greater cost unpredictability and default risk while looking for expanded venture income potential. Like stocks, all securities can introduce the gamble of value variance or market risk to an investor who can't hold them until the development date when the first chief sum is reimbursed to the bondholder. On the off chance that a financial backer is compelled to sell or exchange a bond before it develops and the bond's cost has fallen, the individual in question will lose part of the principal investment as well as the future income stream. Another risk common to all bonds is interest rate risk. In normal conditions, when market loan fee levels rise, existing bonds' market estimated valuations normally drop, albeit past execution doesn't guarantee future outcomes. Notwithstanding, loan cost chances impact on market worth might be a moderately minor element for money situated, purchase and hold venture methodologies. That's because bondholders are generally entitled to receive the full principal value of their bonds at maturity, regardless of any short-term changes in market value that might have been caused by fluctuations in market interest rates. Of course, diversification generally cannot assure a profit or protect against a loss, and investments in mutual funds carry specific costs such as management fees and operating expenses expressed as the annual expense ratio. Sometimes mutual funds also incur sales commissions or redemption fees. The wide variety of bonds may make them potentially suitable in many investment scenarios. Discuss your goals with your financial professional, and together you can decide whether bond investing is right for you.